All right, so welcome back. We're going to try something a little bit new tonight. Instead of doing our traditional video, we are going to go live and do a conversation around the Bank of Canada and the continuing and ongoing mandate that they will have going forward. So, here is the gist of it. No intro tonight, no links, no subscription buttons, no nothing like that. By the way, if you do like this video, do me a favor and subscribe because it helps a lot and hit that like button. But tonight we're going to go directly into the conversation. We're going to talk about the fact that Reuters is reporting that the Bank of Canada will maintain its overnight lending rate. And they will, sorry, not their overnight lending rate. This is a little bit harder going live in this way. They will maintain their mandate going forward with very little to no changes. They are going to continue to target inflation at 2% with an eye on employment rather than taking a look at the 3 to 4 other frameworks that they were potentially looking at or average inflation targeting, which the Federal Reserve US does. So, very much good news for the Canadian economy as the Bank of Canada's mandate is going to maintain the status quo, which means there isn't going to be a lot of flocking to the markets to either get into the market or out of the market because big changes are happening. Because, as we all know, as we've seen in the real estate market, when the government makes changes, it just encourages people to go and buy before the rules change. So, really good news here, really interesting news, and interesting that Thomson Reuters is quoting a unnamed official who is not authorized to speak. Sometimes they purposely let information leak so that there isn't a surprise to the market when they do make the announcement, but you can expect the announcements coming in the next couple of days. So, as we tend to do, I'm going to jump you into the screen here. Well, that's kind of a cool effect because obviously I had the live streaming view up from YouTube. So, going into the news article here, Thomson Reuters, I'm not sure if it's Thomson Reuters anymore. Actually, it's Reuters for sure. Anyways, looking at the U.S. markets, exclusive Bank of Canada to keep inflation targeting, shun big shift in strategy or big strategy shift, says source. So here's the gist of it. Bank of Canada will leave its inflation target at 2% in a framework renewal. Basically, what happens is every 5 years they go ahead, they take a look at the framework that they're using for monetary policy. It's been the same for the last 30 years and they take a look, make sure that the framework is still valid, and on a 5 year basis, they renew it. There was some talk about them shifting the framework this year. There was some talk about them going ahead and making some changes, taking a little bit broader approach, looking at employment and other things, not just inflation. And what it comes down to is that they have very much settled on the status quo was working, is working, and going to look to bring that inflation target back towards 2% over the next several months and into 2022 and continue that for the next 5 years. So all good news there. Lots of interesting things. If you want to go and take a look at the actual press release itself, you can go ahead and do that is when you go and take a look at the other things that happened with respect to the Bank of Canada today. Bank of Canada worries supply chain disruptions could persist. This was an article from a speech given by the Deputy Governor, Tony Gravel, today. Always what tends to happen is when they make a overnight rate announcement like they did yesterday and they don't go into deep detail or provide a monetary policy report, they always tend to give some sort of speech the day after that sheds a little bit of light of what they're thinking going forward. Again, because they're trying not to surprise the markets. And today was no different. Two things that really stick out here is first and foremost, they're looking at inflation and going, this may persist for longer than we thought, which leads them to how do we fix that while maintaining what our mandate is and what we're supposed to do. And one of the things that appears that they're looking at right now is looking at seeing what the full capacity of the economy is, because what they're looking at previously is they're going, okay, what was the economy looking like leading into 2019? And then what they're doing is they're aiming for that same amount of growth in the economy. Sorry, that was my phone ringing again. We're going live, so things are happening. Anyways, they are looking to get back to that amount, that level of growth that was happening pre-pandemic. And what they're looking at right now is they're saying, okay, well, supply chain issues are having a certain effect. And therefore, perhaps because of those supply chain issues, full capacity is actually lower than what it was pre-pandemic because we're going to have a hard time sorting out those supply chain issues. So what that means is that in January, they could move and shift what full capacity means, which means we could get closer to full capacity sooner, which means we could start to see rate increases sooner. We could see them again in that early April timeframe, or maybe we see them in February or March. We definitely won't see them in January unless something really, really big happens. But interesting conversation around the fact that they are definitely looking at what full capacity means in the economy for 2022 and going forward. It definitely isn't what it was in 2019, and that could move forward their timelines with respect again to those rate increases. So lots of interesting stuff here. Obviously, they're looking inflation, they're looking at higher and lower energy costs. They're looking at all the things combined and how that is contributing to the economy and really what's happening there. So, it's there's lots of really interesting conversations around interest rates right now. Some people believe that it's going to go up 8 times in the next 2 years. The market is obviously forecasting 5 times in the next year. And, some people are forecasting less than that. It'll be interesting to see what happens because, much in the same way that they don't know how transitory inflation was going to affect the market, I think they're also probably a little bit concerned about how actual interest rate increases are going to impact the economy. Because if they start increasing interest rates and it doesn't affect inflation, but what it does do is it hurts jobs and it hurts other pieces of the economy, well, they may have to pull back that interest they may have to pull that interest rate increase ideology back as they realize that the interest rates and the economy are significantly more sensitive than they were maybe a year or two ago or three ago, right? So, lots of again, I sound like a broken record because I'm doing this live and there's not as much editing, but lots of interesting things and interesting conversations to be had here. Again, going from a go forward basis, we won't know very much until January, end of January, January 26th, when they release their monetary policy report, their quarterly monetary policy report. Once that comes out, we're going to get a pretty clear picture, I think, of what's going to happen over the next 3 to 6 months. Obviously, if other variants or Omicron becomes something that are of major concern to the economy, that's going to pull back the time frames with respect to increasing interest rates. If we have any sort of other shocks that cause interest rates to go lower fast, or sorry, that cause growth in the economy to not happen as quickly as we imagine that they would, then we're probably going to see longer times at lower interest rates. And the one thing that we can clearly say is that the last 3 to 4 years have been a surprise. Across the board, they've been a huge surprise, and the economy continues to surprise. And the one constant is that. And the big thing that we need to pay attention to is the fact that as interest rates and as things change in the economy, we're going to have more surprises, and that's going to change the outlook on a daily, monthly, even yearly basis. And ultimately, it's going to be really hard to tell where the economy goes from there. So, as of right now, we're still getting huge discounts on variable rates. Fixed rates are priced higher as they always are. Until we see fixed rates and variable rates get closer together, we're still going to recommend a variable rate strategy for your mortgage. And at the end of the day, we're really just trying to stay in tune with what's going on in the economy, doing our best in order to figure it out just as much as everyone else is, and make decisions with the best information we have today, rather than trying to make wild predictions and try to do things with our money and do things with our mortgages based on predictions that may just be wild predictions. So, it's more of the status quo until we know more, but we'll know more in January. Good news, really good news from the finance minister and from the Bank of Canada, stating that we are going to stick with our existing monetary policy for now, because I think big change would cause chaos. And at the end of the day, now we're in a waiting game. So if you found this video useful, if you found this live stream useful, do me that favor, hit that subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video. If you have questions, leave them in the comments. Tell me what you thought of this format in the comments, and we'll see you on the very next video. Cheers.